Hey guys, what's going on? My name's Hayden Crabtree. Today I'm going to teach you a short lesson on what is the UBIT tax. If you're a real estate investor, you may have heard of the UBIT tax, you may have not heard of the UBIT tax. It's really important for you to understand what the UBIT tax is and how it can affect you. Not everyone's going to be affected by it, but it can affect you. So first of all, UBIT stands for Unrelated Business Income Tax. And the main area where it's going to affect a real estate investor is whenever we are using our self-directed IRA or retirement account to actually invest in a real estate asset. Okay, so instead of using personal cash, if we use a tax-deferred, a tax vehicle like a self-directed IRA, the UBIT tax comes into play, and it's actually going to do a couple of things that can become not so advantageous and not actually tax-free. Okay, so what we need to know about the UBIT tax is one, that it's only going to apply to tax vehicles, particularly in our case retirement accounts like a self-directed IRA. And what this is going to do, okay, so the UBIT tax is going to damage us whenever we or an investor of ours uses their self-directed IRA to invest in it and we use debt. If we don't use any debt, then it's no problem. But let's say that we buy a house, okay, and the house is, let's call it $100,000. Let's say we use a bank to give us $70,000. Okay, so out of that money, we're going to have, we'll call it equity of $30,000 into the project. Okay, so in this situation, we use the self-directed IRA to fund the equity of $30,000 into this project. Now, this is obviously 70% loan to value, LTV. Okay, that's the percentage. But one thing we want to understand is, let's say that we hold this property for really any amount of time. Let's say it's 1 day, or let's say it's 1 year, or 10 years. Let's say we go to sell this property and we sell the property for $200,000, okay, and that results in a $100,000 gain, a $100,000 profit, okay? Now, what most people think is they invest in self-directed IRAs because that is not going to have any implications on tax side. So a lot of people think that whenever they do use the self-directed IRA, it's going to be completely tax-free. But here's the thing, and here's where the UBIT tax is really important to know and understand, is that if we use the self-directed IRA in tandem, you know, on the side with a bank's money, then actually the 70-30 split, the UBIT tax is going to come in and say, you guys actually made a $100,000 profit, but 70% of that profit, or $70,000, you made because of the bank. And that's not your money, and that's not protected money. So on this $100,000 profit, you're going to have to pay profit on $70,000 of that, or 70%. So if we had used 50-50, then we'd only be paying profit or tax on $50,000 worth of profit. So really what the UBIT looks at and cares about is how much of the non-tax exempt vehicle did you use in order to make this profit, and then they're going to tax you on the other part. This is extremely important to know, because if you have an investor investing with you in a project, or you're investing in your own project, and you want to tell them, hey, it's great, it'll all be tax-free. We're going to use this loan over here. It's going to be in the form of debt. We'll sell the project. We'll make a lot of money. You'll do it all tax-free. That's really going to hurt, and you're going to look really, really bad if you play this out, and whenever they go and do their tax returns, their IRA now has to pay taxes on $70,000 worth of that. It's really, really going to hurt. Okay, so before you get into this, before you try and raise money from a self-directed IRA, which can be extremely beneficial for a lot of different reasons, you need to know that the UBIT tax is a real thing, and it can harm you in this situation. Not more so than normal, but you do need to know that you can be taxed even on those tax-exempt accounts. Okay, one thing I want to teach you guys, and I learned this from a good friend of mine, Damian Lupo, who's the host of the Financial Underdogs podcast that I've been on, is there's actually called an EQRP, which I believe Damian created. And the EQRP is really cool because just like a self-directed IRA, you do not have to pay taxes on any of the gains. But in an EQRP, you can in fact use the bank loan in tandem with the EQRP, except in an EQRP there is no UBIT tax. So it's the exact same thing as a self-directed IRA mechanically, strategically, but there's a lot of different benefits like no UBIT tax that can make a big difference over the lifetime and growth of that account. Because if you're paying taxes on $70,000, it's going to be, a big chunk of money you're going to have to pay and not be able to reinvest into another project that's not going to be there for you to buy assets and for available use whenever you do retire. So if you're going to do a retirement account, I very strongly suggest you look into the EQRP. Again, that's by my friend Damian Lupo, because there's no UBIT tax and you can do all the same things: checkbook control, buy physical metals, buy real estate, buy stocks, whatever you want to do. So I thought I'd drop this in today. I've heard some questions about self-directed IRAs, and I always point people to this resource mainly because of the UBIT feature. So if you guys want to do that, I'd suggest Googling EQRP. I believe you can get a free book about all the advantages and disadvantages of the EQRP system and how it relates to other projects. So grab that now. If you guys enjoyed this, I ask you please subscribe to the channel. I'll be posting more content like this every single week. As you know, I'm the author of Skip to Flip, and if you want a free book, the link is below. And other than that, I'm here for you guys. If you have any questions, drop a comment below. I'll answer it for you. And if there's anything I can do for you, reach out to me, let me know. And in the meantime, be great.